Silver just did something almost unthinkable. In January, it broke through $100 per ounce for the first time in history, only to lose nearly half its value in a matter of days. Now, sitting at around $82, we're faced with a question that could define your precious metals portfolio for years to come. Is this crash the buying opportunity of a lifetime, or are we staring at a value trap that could drag investors down even further? Friday, February 13th, 2026, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. Let me take you back to January 29th, because what happened that day will go down in silver market history. For decades, silver bugs and precious metals enthusiasts had been waiting for this moment. The white metal finally shattered the psychological barrier of $100 per ounce. Social media exploded with celebration. Forums were buzzing with predictions of $200, even $300 per ounce. The euphoria was palpable, intoxicating even. Silver stackers who had been accumulating physical metal for years felt vindicated. This was their moment. The industrial metal with monetary properties was finally getting the respect it deserved. But then something extraordinary happened. Within days, the dream turned into a nightmare. Silver didn't just pull back or consolidate. It crashed with a violence that shocked even seasoned traders. We're talking about losing nearly 50% of its value in what felt like a blink of an eye. Imagine watching a $100 asset plummet to around $50. The whiplash was brutal. Those who bought at the top were suddenly staring at devastating losses. The question on everyone's mind was simple. What the hell just happened? Enter U.S. Treasury Secretary Scott Bessent with an explanation that added fuel to an already raging fire of speculation. According to Bessent, Chinese traders were behind the extreme volatility. He characterized the massive January rally as a speculative blow-off, essentially suggesting that what we witnessed wasn't organic price discovery driven by fundamentals, but rather a speculative frenzy that inevitably had to collapse under its own weight. Whether you buy that explanation or not, the damage was done. Billions of dollars in paper wealth evaporated. The silver market had experienced one of the most dramatic boom-bust cycles in modern commodity history. So here we are today, February 13th, with silver trading at $82.90 per ounce, down $1.25 or about 1.5%. Just 2 days ago, we saw a local high of $84.72, suggesting that perhaps the worst of the carnage is behind us. But let's put this in perspective. We're still down about 33% from those January highs. That's not just a correction, that's a significant decline that has left many investors wondering whether they should cut their losses, hold on for dear life, or actually use this as an opportunity to add to their positions. The technical picture right now is fascinating if you're into chart analysis. Silver is testing what traders call a 38.2% Fibonacci retracement level at $81.85. For those unfamiliar with technical analysis, Fibonacci levels are mathematical ratios that traders use to identify potential support and resistance zones. This particular level is often described as make or break because it can signal whether a market is likely to continue recovering or face another leg down. The fact that we're hovering right around this critical level tells us we're at an inflection point. The next move could set the tone for the coming weeks or even months. Now let's talk about why, despite this carnage, there might actually be a compelling case for silver at current levels. And I want to be very clear here. I'm not telling you to buy or sell anything. What I'm doing is laying out the facts and the arguments on both sides so you can make your own informed decision. The bull case for silver isn't just about price action or technical levels. It's rooted in some pretty fundamental supply and demand dynamics that haven't changed despite the January volatility. Here's something that should make your ears perk up. The silver market is heading into its 6th consecutive year of supply deficit. We're talking about 67 million ounces more demand than supply. Think about that for a moment. For 6 years running, the world has been consuming more silver than it's been producing. In any other market, sustained deficits like this would typically lead to higher prices over time. It's basic economics. When you can't produce enough of something to meet demand, prices should rise to either encourage more production or ration consumption. Yet here we are with silver having just crashed 33% from its highs. The sources of demand are particularly interesting in today's economy. We're living through an artificial intelligence revolution, and guess what AI needs? Data centers. Massive, power-hungry data centers filled with servers and networking equipment. And what's a crucial component in all that electronic infrastructure? Silver. The automotive sector is another major consumer, particularly as we transition toward electric vehicles, which use significantly more silver than traditional combustion engine cars. These aren't speculative future demands. These are real, growing industrial needs happening right now. But here's where it gets even more intriguing. The gold-to-silver ratio currently sits at about 61.2 to 1. This means it takes roughly 61 ounces of silver to buy 1 ounce of gold. Historically, this ratio has compressed significantly during precious metals bull markets. There have been periods where the ratio dropped to 30 to 1, or even lower. If we're truly in a precious metals bull market driven by monetary concerns, inflation fears, and geopolitical instability, then silver could have substantial room to run just to catch up with gold. This is exactly the argument that Bank of America is making with their absolutely stunning price target of $309 for 2026. That would represent a 279% gain from current levels. Now, does that mean it will happen? Of course not. But it illustrates the magnitude of potential upside if historical patterns repeat. Alan Hibbard from Gold Silver is similarly bullish, expecting silver to outperform this year compared to last year, with potential prices exceeding $175 per ounce. These aren't fringe commentators making wild predictions on obscure blogs. These are serious market participants with track records and reputations on the line. Let's also consider the monetary policy backdrop. Markets are currently pricing in roughly 60 basis points of Federal Reserve interest rate cuts by year-end. That's more than 0.5% of easing. We've already seen economic data that supports this view. December retail sales unexpectedly stalled, and the GDP control group actually fell by 0.1%. When the Fed cuts rates, it typically weakens the dollar and makes non-yielding assets like precious metals more attractive. Lower interest rates also reduce the opportunity cost of holding silver instead of putting your money in interest-bearing accounts. And here's something that often gets overlooked in all the price volatility. Physical demand is actually strengthening. Coin and bar purchases have picked up in recent months. Global exchange-traded product holdings stand at an estimated 1.31 billion ounces. Despite the crash, people are still accumulating physical metal. The smart money, or at least some portion of it, seems to be viewing these lower prices as an opportunity rather than a warning sign. Geopolitical tensions remain elevated, and there's persistent uncertainty around U.S. economic policy and even concerns about Federal Reserve independence. These factors traditionally drive investors toward precious metals as safe haven assets. In times of uncertainty, tangible assets that can't be printed or manipulated by central banks become more appealing. Silver, with its dual nature as both an industrial and monetary metal, benefits from both the flight to safety and the growing industrial demand. But let's pump the brakes for a second and look at the other side of this coin, because ignoring the bear case would be intellectually dishonest and potentially financially dangerous. Industrial fabrication, which represents a huge chunk of silver demand, is actually forecast to decline by 2% in 2026 to around 650 million ounces. Part of this weakness is coming from the photovoltaic sector, which has been a major growth driver for silver in recent years. If solar panel manufacturing slows down or becomes more efficient with silver usage, that's a headwind. There's also the uncomfortable truth about that January rally. Treasury Secretary Bessent might be right. It might have been primarily speculative in nature. When you see parabolic moves like silver going to $100 in a short period, it often attracts momentum traders and speculators who don't really care about fundamentals. They're just riding the wave. And when those players exit, the crash can be just as dramatic as the rally. The fact that we saw a 50% decline suggests there was a lot of froth in that rally that needed to be cleared out. Volatility is likely to remain elevated. Anyone considering silver right now needs to have the stomach for wild price swings. This isn't a set-it-and-forget-it investment. We could easily see another 10 or 15% drop before any sustained recovery. We could also see a quick spike back above $90. The point is, if you can't handle watching your position fluctuate dramatically, silver might not be for you right now. There's also the broader economic uncertainty to consider. While some see recession risks as bullish for precious metals, it's more nuanced than that. If we see a significant economic slowdown, industrial demand could weaken further. Yes, investment demand might pick up as people seek safety, but it's not guaranteed that one will offset the other. So where does all this leave us in terms of future direction? In the short term, the next few weeks to months, I think we're going to see a period of consolidation. That 81.85 Fibonacci level is crucial. If silver can hold above that support, we could see a grind higher toward $90 and potentially back to test the recent high around 85. If we break below decisively, we might see a test of the mid-70s. For the medium-term outlook through the rest of 2026, much will depend on what the Federal Reserve actually does versus what the market expects. If those rate cuts materialize and we see real monetary easing, that should be supportive for precious metals broadly. The supply deficit story isn't going away. 67 million ounces of shortage doesn't resolve itself overnight. Mining production can't just be turned on like a switch, and many of the best deposits have already been exploited. The wild card is industrial demand. If AI and data center growth continues at the pace we're seeing, and if the automotive transition to electric accelerates, we could see industrial demand surprise to the upside despite the photovoltaic headwinds. Technology tends to find new uses for useful materials, and silver's unique properties, particularly its electrical conductivity, make it irreplaceable in many applications. Geopolitical catalysts could also drive prices. Any escalation in global tensions, whether it's trade disputes, military conflicts, or currency crises, tends to send investors scrambling for precious metals. We're living in an increasingly multipolar world with declining trust in traditional financial institutions. That's a structural backdrop that favors hard assets. Here's how I'd think about this if I were in your shoes, and again, this isn't financial advice, just how I'd frame the decision. If you're a long-term stacker who believes in holding physical precious metals as insurance against monetary instability, these price levels might look attractive for adding to your position methodically. Dollar cost averaging in over time rather than trying to catch the exact bottom makes sense given the volatility. If you're a trader looking for short-term gains, you better have tight stop losses and be prepared for whipsaw moves. This market can and will fake you out. The technical setup is interesting, but it's not a slam dunk. If you're looking at silver as a portfolio diversifier, the case remains intact. Precious metals typically have low or negative correlation with stocks and bonds. Having some exposure can smooth out overall portfolio volatility. Whether you allocate 5% or 15% depends on your risk tolerance and outlook. The question we started with was whether silver at $82 is a buying opportunity after a 33% crash. The honest answer is, it depends on your time frame and what you believe about the underlying fundamentals. The bull case is compelling. Sustained supply deficits, growing industrial demand from transformative technologies, potential Fed easing, and expert targets suggesting massive upside. The bear case is real too. A speculative blow-off that might not be finished, industrial demand showing some weakness, and volatility that could shake out weak hands. What I do know is this. Silver has survived crashes before and come back stronger. The fundamentals around supply constraints are real. The industrial revolution in AI and electrification is real. Whether that translates into $175 silver or $309 silver this year, I can't tell you with certainty, but I can tell you that at $82, we're a lot closer to value than we were at 100. Let me know in the comments what you think. Are you buying this dip, staying on the sidelines, or actually taking profits on any rallies? What's your price target for silver by the end of 2026? And don't forget to drop George Williams in the comments to help support this channel. The conversation we're building here matters, and your engagement makes it possible. Thanks for watching, and I'll see you in the next one.